Let me ask you something that most crypto content will never actually address. If you lined up every altcoin in the top 50 by market cap right now, with all the charts, all the roadmaps, all the Twitter threads, how would you even begin to decide which one deserves your money in 2026? Most people cannot answer that. They pick based on what they saw trending, what a YouTuber mentioned, or what feels cheap enough to justify the gamble, and then they wonder why they keep losing. Here is the honest truth about this market right now. We are sitting in one of the most compressed altcoin environments in years. Bitcoin dominance is hovering near 59%, which historically has marked the late stages of what traders call Bitcoin season, the phase where capital pools into Bitcoin before rotating hard into everything else. The altcoin season index climbed to 55 earlier this year. Those two data points together mirror the setup that preceded the 2016 to 2017 and 2020 to 2021 altcoin expansions almost exactly. That does not guarantee a repeat, but it tells you the structure is familiar. So the question is not whether altcoins will move. The question is which ones move for real reasons and which ones move on hype before collapsing back to nothing. Because the other thing we know from history is that more than 70% of altcoins launched in previous cycles never recovered after major downturns. 70%. That is not a fringe outcome. That is the base case for most tokens. What we are going to do today is build you an actual framework for thinking about altcoin selection in 2026, and then walk through the 4 assets that hold up best when you apply it. No pre-sales, no meme coins, no projects that require you to trust a pseudonymous team and a white paper. We are talking about coins with real on-chain data, institutional presence, and verifiable utility. Coins that a thoughtful person can explain to someone else without feeling embarrassed about it. Here's the framework, and it comes down to 4 filters. Utility, meaning does the network actually do something that matters and cannot be easily replicated. Momentum, meaning are institutions and developers moving toward it or away from it. Risk-adjusted upside, meaning how much can it realistically gain relative to how much it could fall. And resilience, meaning has it survived multiple bear cycles and come out structurally stronger each time. Every coin we cover today passes at least 3 of those 4 filters. If something only passes 1 or 2, it does not make the cut regardless of how exciting the narrative sounds. The first coin is Ethereum, and before you roll your eyes and say you already know about Ethereum, hear me out, because the Ethereum setup in 2026 is different from anything we've seen from it before. Ethereum is trading at roughly 60% below its 2025 highs. That is not a small correction. That is a major repricing that has left institutional analysts scratching their heads. Fundstrat's Tom Lee publicly called Ethereum severely undervalued earlier this year. Layer 2 networks like Arbitrum and Base have scaled to the point where Ethereum's base layer handles the settlement of value that smaller chains handle all their transactions on. Think of it less like a consumer app and more like the Federal Reserve's clearing system. You do not interact with it every day, but every transaction in the system flows through it. The Pectra upgrade earlier this year improved staking mechanics and network efficiency. Spot Ethereum ETFs are live and accumulating. Total value locked in DeFi protocols on Ethereum and its Layer 2 ecosystem holds somewhere around 75% of the entire DeFi market. No other chain comes close to that figure. And when real-world asset tokenization, which is the single biggest institutional narrative in all of finance right now, needs a settlement layer, Ethereum is the default choice for the firms writing the biggest checks. The risk here is real. Competition from Solana, Avalanche, and emerging Layer 1s is genuine. Ethereum's developer onboarding has slowed compared to the peak of its dominance, and fee revenue has compressed because Layer 2s are absorbing so much of the activity. But for an investor optimizing for consistency over raw percentage gains, Ethereum offers something almost nothing else in crypto does: institutional downside protection. When major ETF providers and asset managers are already holding it and adding to positions, the floor is structurally higher than almost any other altcoin. If you are building a position right now, Ethereum is the anchor. The second coin is Solana, and this is where the conversation shifts from steady to explosive. Solana hit 27.1 million active addresses in mid-January 2026. That's a 56% weekly increase. The Alpenglow upgrade is targeting 150 millisecond finality, which is close enough to real-time that it starts making traditional financial infrastructure look slow. Solana ETF assets under management crossed $1 billion, with Bitwise's BSOL fund capturing the majority of inflows. The Chicago Mercantile Exchange launched CFTC-regulated Solana futures and options, which is the kind of institutional validation that signals serious money is treating this network as a legitimate asset class, not a speculative toy. Here's what makes Solana genuinely different from other fast and cheap competitors. The developer ecosystem didn't just survive the FTX collapse of 2022, it grew. Applications built on Solana across decentralized exchanges like Jupiter, consumer crypto wallets, and NFT infrastructure kept expanding even during the worst sentiment the network had ever faced. That kind of ecosystem resilience is hard to manufacture. It tells you the underlying developer conviction is not dependent on price action. The honest caveat is this: Solana is the most volatile of the major altcoins. It moves harder in both directions than almost anything else in the large-cap space. If macro conditions turn risk off again, if tensions escalate somewhere geopolitically, or the Federal Reserve signals rates staying higher, Solana tends to fall faster and further than more mature assets. That's the trade-off. The upside case in a favorable cycle runs to multiples that Ethereum cannot match from current levels. The downside case involves drawdowns that will test your conviction at every step. Position sizing matters enormously here. The third coin on this list is one that gets discussed constantly, but is still deeply misunderstood by most retail investors. That coin is XRP, and the reason it belongs here is not the community, not the speculation, not the price targets that circulate on social media. It's a single, documented, verifiable shift that happened this year that changes everything about XRP's risk profile. The SEC classified XRP as a digital commodity on March 17th of this year. That classification ended years of regulatory limbo that had frozen institutional adoption of XRP in place. Financial institutions that were watching the lawsuit unfold and keeping their distance are now free to build on the XRP ledger without the legal exposure that previously made their legal teams nervous. Singapore's central bank has already been testing finance settlements on the XRP ledger. Cumulative XRP ETF inflows hit $1.44 billion, and exchange balances, meaning the amount of XRP sitting on exchanges available for sale, fell 57% to 1.7 billion tokens, which is one of the clearest demand signals an asset can produce. Here's what you need to understand about the risk. XRP's upside in 2026 is heavily catalyst-dependent. The base case requires continued ETF momentum, expanding Ripple payments volume, and regulatory wins maintaining their trajectory. If those catalysts materialize, analysts across multiple models target 200% or more upside from current levels. If they stall, XRP gives back gains faster than most people expect. The pattern of XRP ETF flows weekly already shows this dynamic in action. Flows dropped from $200 million at launch to $640,000 in recent weeks, which tells you the initial excitement has normalized, and the next move depends on new developments rather than momentum carrying over. Buy it because you believe in the specific catalysts, not because you believe in the community's price predictions.
The fourth coin is the one most people watching this are sleeping on, and that coin is Chainlink. Chainlink is not a consumer-facing blockchain. You will never open a Chainlink wallet. You will never send link to pay for coffee. What Chainlink is the invisible infrastructure that makes the entire concept of real-world assets living on blockchain physically possible. A smart contract on Ethereum or any other chain is fundamentally sealed off from the real world. It cannot natively know the price of gold, the interest rate set by the Federal Reserve, or whether a flight landed on time. Chainlink is the network that brings all of that external data on-chain in a tamper-proof, decentralized way. Without it, the tokenization of the global financial system cannot function. The numbers here are staggering. Chainlink's oracles secured over $93 billion in on-chain value across ecosystems in 2025. Total value executed using Chainlink Oracle data hit $27.3 trillion by November of 2025. Cross-chain transfers via Chainlink's CCIP surged 1,972% to $7.77 billion. The network dominates 67% of the Oracle market and is deployed across over 60 blockchains. The institutional roster is what separates Chainlink. Swift, JP Morgan, MasterCard, Fidelity International, UBS, and ANZ are all integrated with Chainlink services. Amundi launched a $100 million tokenized fund using Chainlink oracles. Fidelity International tokenized its $6.9 billion liquidity fund using Chainlink as the data standard, and the U.S. Department of Commerce uses Chainlink to publish official economic data like GDP and inflation directly to blockchains. The Grayscale Chainlink Trust ETF launched in December 2025, giving traditional investors regulated exposure to Link, and yet the price has remained relatively flat. That disconnect between explosive utility and muted price action is exactly the kind of setup that precedes major repricing when conditions shift. The risk with Chainlink is patience. It does not move on hype cycles. It moves when institutional adoption becomes visible enough for the market to price it in. If you are looking for something that pumps next week, this is not it. If you are building exposure to infrastructure that the tokenized economy depends on, it becomes much more compelling. So here is the framework summary. Ethereum is your foundation. Solana is your growth engine. XRP is your catalyst play, and Chainlink is your infrastructure bet. One more thing before you go. None of this is investment advice. Crypto markets are volatile, unpredictable, and capable of producing losses that will test your discipline. No framework removes that risk. It only reduces the chance that your losses come from ignorance. The goal is to hold positions you can actually explain and understand well enough to hold through corrections without panic selling. That is the standard worth holding yourself to in 2026. If this helped you think more clearly, hit the like button, subscribe for more breakdowns like this, and answer this in the comments. Which of these four is the most undervalued right now? Ethereum, Solana, XRP, or Chainlink? And if you know someone still picking coins based on hype, send them this, because the coins that survive are the ones people actually understand. Do the work, stay sharp.